think we are going to triple-digit silver again, but I don't think it's a week from tomorrow. Paper paradigm still has some power.
$6,000 gold doesn't really work with $40 silver.
No, it doesn't. It could get to like an 80 once the Chinese New Year situation shut down the markets. That's when all this paper got sold, and we got that whatever it was yesterday, $8 or $9 move down. COMEX has got about 93 million in the registered category. Shanghai's about 10 or 11 million ounces. LBMA is really a tough one to figure out because most of that London metal is in the ETFs.
Shanghai is instituting rules that you can't short what you don't have. Did you see that story?
If equilibrium is met in the Asian market or the Shanghai Metals Exchange, everyone that's demanding physical to either import it or keep it for future industrial purposes, if that demand is satisfied and we reach equilibrium, we could see a stabilization in the price. Once this market really gets hot, there'll be moose pasture selling as if it's a top tier because people will be late to the party that want to catch up.
What do you think? Is this different this time? Or are we going to go straight back down?
Well, I think it's different this time, but to put it in a little bit of context, many in our community have talked about this is the worst sell-off in silver's history and da-da-da-da. Well, it's the second worst to my knowledge, because the first worst was called Silver Thursday. I think it was March 27th, 1980. Silver went from $20.61 down to $10.27 in one day. That's a 50% chop. Not a 30 or 33% chop. Not that this 30% plus chop wasn't hair raising. Still got some left, but it wasn't the worst. I think to follow up real quick, we're not done yet. Everything I know about how metals trade, the algorithms are not. We are still in a secular bull market. We're in the final phase of it to my strong studies. And I think we are going to triple-digit silver again, but I don't think it's a week from tomorrow.
After that type of event, yeah. And we saw it even here. Things were seemingly stable and everything was fine. Then all of a sudden the silver fell, $6 or $7 in about 6 or 7 minutes.
The real story here isn't the drop. It's how algorithmic liquidity can erase billions in value within minutes. As David Morgan reminds investors, the 1980 Silver Thursday collapse saw a 50% single-day crash, dwarfing today's volatility and showing how leverage cycles repeat across decades. The sudden $6 to $7 intraday move reflects thin futures liquidity, not collapsing fundamentals. Institutional positioning and automated trading systems now amplify price swings far more than retail demand ever could. David Morgan next points toward why volatility itself may signal the final phase of a metals cycle.
Yeah, if I could put it again in a larger context, I mean, I'm pretty convinced that the one thing that I think we've all been looking for, meeting the precious metals people, we were waiting for that day when the physical market took control of the price. And we got there. I'm convinced we got there. And it was based upon physical 1,000-ounce commercial bars, which is the silver market. It is a derivatives market, but under all the derivatives, there lies a 1,000-ounce bar, or 10 of them, or 20 of them, or 1,000 of them, or 10,000. And that demand was moving the actual price for quite some time. But the paper paradigm kept moving along with it. It got overextended, went up, 140% in a year, and then we do 70% in a month. I was warning my group, my members, and the public, on shows like yours, that look, nothing goes up that fast without having some kind of a correction, some kind of a pullback. We got it. It gasped a lot of people that haven't experienced the futures market before. And here we are consolidating. Back to the 10, the big move yesterday. A bit of a surprise, honestly, but it shows that the paper paradigm still has some power. So I think it's a struggle now between the reality of physical silver and the paper derivatives market still having a lot of control at times.
Headlines celebrate physical demand, but derivatives still dominate daily price discovery. As David Morgan explains, a 140% annual rally followed by a 70% monthly surge is historically unsustainable without a correction phase. futures markets still set marginal pricing because COMEX leverage ratios often exceed available deliverable metal by multiples. That tension between physical accumulation and paper leverage is exactly where volatility is born in commodity cycles. David Morgan next hints at why this tug of war between physical buyers and paper markets may intensify.
Well, that would kind of be the key question, I guess, David. You know, the Hunt Brothers episode in 1980 was a COMEX focused event. What was happening in April of 2011 was a COMEX focused event. This current rally does not seem to be a COMEX focused event. It seems as if almost like Shanghai was leading the whole expedition back in January. Do you sense that as well? And if so, does that continue going forward?
Absolutely, that's what did it. I mean, I think, that could be proven pretty easily, objectively. But does it continue? And I'll have to be honest, I don't know. I have said, and I'll say it again, if equilibrium is met in the Asian market or the Shanghai Metals Exchange, Shanghai Futures Exchange, and everyone that's demanding physical to either hoard it or keep it for future industrial purposes or long-term investment, if that demand is satisfied and we reach equilibrium, we could see a stabilization in the price. That's just a fact. Now, does that mean it's going to happen? I don't know. Could it happen? Probably could. I call it a low probability. I think that between gold's consistent march up and up and up because of currency debasement, silver will march to that tune alone without any increased industrial demand. But there is always the chance, or I should say chance, there's always the re-engagement that we've already seen, that they're marching hand in hand. Industry, investment, industry, investment.
The geography of price discovery may be shifting quietly from New York to Asia. As David Morgan notes, past silver spikes in 1980 and 2011 were COMEX driven, but this rally appears influenced by Shanghai physical demand flows. China now accounts for over half of global industrial silver consumption, meaning pricing power could gradually migrate east. Currency debasement trends supporting gold since 2022 also create a macro floor under silver even without industrial demand acceleration. David Morgan next signals why global demand balance, not speculation, may determine price stability.
So I still think for both purposes it's going to move higher, but even if it's only investment demand, it's such a small market, that alone I think will keep us going higher.
It's funny you mentioned gold. I was the one being interviewed earlier today, and that was a point I mentioned. You know, the gold has been on this steady climb for 2 years of 20% rallies and then periods of consolidation, another 20% rally, another period. And we just got through with another 20% rally. If that trend continues, the next target would be $6,000. David, how important do you think that is for maintaining silver? Because at some point, $6,000 gold doesn't really work with $40 silver.
No, it doesn't. And, I think one of the things that, is kind of poo-pooed, but I think very important, if you know what you're doing with the data. I mean, some people look at, this is new. Well, they don't know how to interpret it. The gold silver ratio I think is important. And it's kind of a slide from here, Craig. I hate to say it, but facts are facts. And you could get to like an 80 again, where you get, silver very undervalued relative to gold. If that were to occur, I'd probably buy more silver.
The gold-silver ratio often reveals value gaps long before markets react. As David Morgan highlights, gold's repeated 20% rally and consolidation cycle over the past 2 years reflects steady monetary demand rather than speculation. Historically, when the gold-silver ratio approaches 80, silver tends to outperform in subsequent cycles as relative valuation normalizes. For investors, that ratio acts like a macro valuation signal, similar to equity sector rotation indicators. David Morgan next points to how relative pricing between metals could shape the next allocation cycle.
I probably have enough not to be looking in the eye, but if it gets that undervalued relative to gold, why would I buy gold at that point with that kind of a gold silver ratio? Not saying it will get there. I'm just looking at a chart, seeing what the resistance levels are, and aren't any. It's like a slide to that level Does that mean it's going to get there? No, it does not. But what it does mean is it's an easy path to get there.
So, all right. So as we watch this then going forward, because Shanghai was such a focus, and there's, we're going to have, Shanghai's going to be closed next week for the Chinese New Year holiday. You wonder how that's going to impact things with the trade for the next couple of days. But do you think that shift is now permanent? Is it that kind of more physically based market now going to start wagging the dog instead of the futures markets in New York?
Well, first things first. I mean, once the Chinese New Year situation shut down the markets, that's when all this paper got sold, and we got that, whatever it was yesterday, $8 or $9 move down.
When one major exchange pauses trading, liquidity gaps expose who really controls price movement. As David Morgan suggests, the Shanghai holiday closure, coinciding with an $8 to $9 drop, shows how futures-driven markets still dominate short-term pricing. Thin liquidity windows, especially during global holidays, often create exaggerated commodity moves, similar to bond volatility during low-volume sessions in August 2023. For investors, this highlights timing risk more than fundamental weakness in silver demand. David Morgan next questions whether physical markets can permanently override futures pricing power.
So that's point number two. The question you asked is, it's a back and forth, Craig. I really believe that. The market knows more than me, and it keeps us all humble. I think the paper pushers are kind of in charge right now, and there's a stall in the market where there's no market on Monday. And people that run the printing presses have more strength than people that are abstaining from the market due to the Chinese New Year. But when it comes back in the long term, a fact is a fact, and that is the physical market will take control. I'm not convinced. I just ran some numbers, Craig. I like to kind of repeat them. Best I could do, doesn't mean they're perfect, but the LBMA, COMEX has got about 93 million in the registry category. We all know that Shanghai is about 10 or 11 million ounces. And LBMA is really a tough one to figure out because most of that London metal is in the ETFs. But of that 891 tons, I forget the number, Craig, you might know it. I think it's only like 300 million or 250. That's actually free float.
Yeah, it's not in the ETFs.
Not a lot. So, So the point is, the place that's taken the metal off the exchange more rapidly than anywhere else.
Exchange inventory numbers sound large until you compare deliverable supply to paper claims. As David Morgan points out, COMEX registered silver near 93 million ounces, contrasts sharply with billions of ounces tied to global trading demand. The LBMA's estimated 250 to 300 million ounces of free float highlights how little physical metal is truly available relative to ETF and futures exposure. That imbalance mirrors leverage conditions seen before commodity spikes in 2006 and 2010. David Morgan next explains why metal leaving exchanges may matter more than price charts.
Coming off the COMEX, and London. But it's really, whatever goes into Shanghai is coming right out and has been that way for several months now. So I do think we are going to see that again. I really do.
There's been reports this week, David. I find this is the type of thing that just, I'm sure this gets you as well, how Shanghai is instituting rules that you can't short what you don't have. Did you see that story?
I've seen it, and I'm not saying I agree with a lot of this stuff. Cannot be verified. Some of it can.
Yeah.
It's really tough. If it was a no shorting at all, in my mind, I'm not saying I'm right. It's, well, why not have a cash market only? What would be the purpose of a futures exchange? Wouldn't make any sense, would it?
Right. But their rules are that you've got to prove you actually have the metal so that then you can claim you're hedging it.
Well, I'll take that back. My brain just kicked back into gear. Sorry, I only want a cup of coffee so far. Yeah, that would be legit if you're a hedger. So,
what a novel idea, David.
Yeah.
You can only short what you have.
What you have. What a concept. I know.
Jeez. And here we are. The communist Chinese marketplace seems more fair and whatever. All
I'll
right,
have
well,
to
anyway.
tag on that.
The idea of short only what you own challenges the leverage foundation of modern commodity markets. As David Morgan notes, Shanghai reportedly tightening short-selling rules would align futures trading more closely with physical inventory constraints. Western commodity exchanges often allow leverage ratios exceeding 20-1, which can suppress price signals during heavy speculative activity. If Asian exchanges emphasize physical backing, price discovery could gradually shift toward real supply-demand fundamentals. David Morgan next explores how global exchange rules could reshape commodity market power.
And I know we have limited time, but honestly, I've only been to Beijing once. I've been to Hong Kong numerous times, but mainland China one time. But when I was there, it was probably about 2008. But honestly, I said to everybody that I knew after I left that there's places in China that are much more free market than we are. And that was the truth. Now, not that it isn't Communist Party run and all that. I'm not trying to diss that off. But you get out in the country, they have a saying that can't speak Mandarin, but the saying is the emperor is very far away. In other words, our community's doing what we want, it works for us, and this is what we're doing. Come and get us kind of an attitude.
Yep. David, at the Morgan Report, you've often, you follow silver mining stocks as well. I'm sure you've seen, I think Tavi Costa maybe had a chart of the relative valuation of silver versus the silver miners, being pretty much at all-time lows because there's so little participation. We're sitting on the edge of a big week for fourth quarter earnings out of a lot of silver miners. What are your thoughts on that whole sector of the mining department, if you will, and going forward?
It's the best place to go into money. If you're new to the sector,
mining stocks often lag metals prices until late cycle capital finally flows into the sector. As David Morgan references, silver miners trading near historical valuation lows relative to silver itself suggest weak investor participation despite rising metal prices. During the 2020 to 2021 metals rally, mining equities lagged bullion by nearly 6 months before institutional capital rotated into producers. With fourth quarter earnings approaching, cost inflation and production guidance will matter more than silver's headline price. David Morgan next explains why mining equities may offer leverage but also risk for new investors.
I mean, I always stress physical first. You spot mining, whoever you're comfortable with. But once you've got, 2 or 3 months worth of physical metal as a last resort, monetary unit, then why not move into something where you got some leverage and it's undervalued? And that's the mining shares, no doubt about it. And, someone with the clout of a Rick Rule sold silver or most of it or 3/4 of it and been in pretty much in the mining shares. And there's one, I won't name the name, but there are problems mining anywhere. And Mexico, unfortunately, has a lot of cartel problemos. And one that we just put on the list got hit pretty hard. And it's upsetting, but it's the real world. It's actually an opportunity not to make a big bet because you don't want to bet big on those type of situations, but it's one of the best in the West and it's half price. So it's on sale. So you could speculate with, 1,000 or 2 or 10, whatever your, percentages are for your portfolio size, probably doubling your money pretty quickly and sell it and ride that second half for free. I'm not going to give investment advice. I'm just telling you what Jim Dine started, 40 years ago, called a free trade. When you double in a junior, sell half and keep the rest for free. That way you can't lose.
Leverage sounds exciting, but geopolitical risk is the part investors quietly underestimate. David Morgan is pointing to the classic metals ladder strategy: physical first, then miners. But the Mexico mining example shows how jurisdiction risk can erase value overnight. Mining equities historically move about 2 to 3x the underlying metal price during bull cycles, yet operational disruptions can reverse that leverage just as quickly. The free trade strategy works only when liquidity is strong and timing is disciplined, especially during volatile commodity cycles like 2008 or 2020. David Morgan next hints at why portfolio structure matters more than individual mining picks.
There's so few primary silver miners. I mean, Eric Sprott complains about this all the time, how hard it is to find silver mining stocks. Where do you start in your evaluation of them? And I mean, do you look for the actual producers? Do you like more exploration companies?
Well, I've had metrics since I started the Morgan Report because I got burned as a young man and a junior so badly. I didn't want any of my readers to make the same mistakes I did. So I've started off weighting the portfolio like 70% in the blue chips, 20% in the mid tiers that are producers. A good bet on junior producers, which is kind of that sweet spot when the market's hot because they're already producing. They might be producing just at the margin. They're all sustaining costs is 30 and silver's at 32. I know it's at 80 today or 70s today, but you get my point. And then the rank speculations, and that's gambling. So if you structure it the way I do, you've done well. Not, and have I made some misses? You bet I have. Where have I missed the most? In the ranked junior.
Scarcity of true silver miners is the structural constraint few investors model correctly. David Morgan is describing portfolio weighting more like institutional resource funds than retail speculation, emphasizing that only a small fraction of listed miners are primary silver producers. Historically, less than 30% of global silver supply comes from primary silver mines, which explains why mid-tier producers often outperform during commodity upcycles. The all-in sustaining cost example highlights how thin profit margins amplify upside when silver rises, similar to the 2016 mining rally where many juniors gained over 200%. David Morgan then shifts toward the most dangerous segment of the mining cycle, speculation.
I used to have a hot hand there, but that's, bragging 20 years ago. Nonetheless, once this market really gets hot, there'll be moose pasture selling as if it's a top tier because people will be late to the party. They'll want to catch up. They'll play catch up. They'll look for cheap stocks. They'll buy something with gold or silver in the name, not doing any due diligence whatsoever at all. Let their emotions run and buy a penny stock.
Late cycle mining rallies often reward promoters more than investors. David Morgan is describing the classic commodity bubble behavior seen in 1979, 2011, and even smaller cycles like 2020 when low-quality exploration companies surged simply because they had gold or silver in their name. Data from past mining booms shows retail participation spikes near cycle tops, often visible through penny stock volume explosions and newsletter promotions. This emotional chasing usually coincides with peak metal sentiment rather than sustainable fundamentals or production growth.